Well, this is something which the entire nation is going to mourn. Our martyrs at Pulwama and the dastardly act that took away their lives. Well, we have to talk brass tacks. This is going to have an impact on markets as well. Jitters of or fears of war, fears of some kind of a reprisal. All these will definitely play on people's minds. Even if it is not a direct impact on markets, it's certainly going to be a somber day for anyone, anywhere in India. But besides that, the kind of news that we have got from global markets are not very cheerful. It's a bad combo. There is negative growth cues coming in, very bad retail sales numbers from the United States has taken away a bit of the risk on sentiment. The risk appetite has been sapped. And along with that, we have negative news in terms of crude inching up a little more towards 65. Not a very ugly number, but in combination, it's not looking good. And the third set of negative cues for us are coming in the form of results. A lot of numbers, actually. Nestle, Eveready, Voltas, Jet Airways, of course. All of them are not giving a picture of a very healthy corporate India. So today, cues look negative. We don't know what the technicals are saying. That, of course, Anuj will clarify. But fundamental cues are not looking too positive. Hi, both of you.
Hi Lata, good morning. Anuj, morning. And today is Friday. So for the last three Fridays, we've been having these big accidents in the market. You never know what the accident could be today. But having said that, 4 straight days now of FI selling is what we've seen. So FI sold once again 250 crores in the market yesterday. Just look at that graph. There was big selling in the F&O market as well. Anuj, morning. Do you get a sense that this downtrend that we've been seeing all week is something that could continue? Now we even have, some negative cues coming in from across the globe as well.
Morning, Sonia. My sixth sense is that perhaps the accident today could be about the market itself. Look, the market is looking very precariously placed. Now, like we discussed, perhaps it would not have fallen yesterday. Yesterday was also the weekly options expiry day. The data is very interesting. The FIs have gone all in on the short side in yesterday's trade. I mean, this is not normal selling that we saw yesterday. And yesterday the DI buying was so much, still the market was down. So 3,600 crores has been sold in index futures yesterday. That's plain naked index futures selling. In that there's been unwinding of 27,500 longs and adding of 17,900 shorts. The long exposure in just one day has gone down from 55% to 49%. Now, on normal days, I look at this data with a slightly reverse point of view that if these shorts don't get followed through, what will happen to the market? But the overall texture of the market, you're not able to engineer any kind of rally. 10,750 was a strong support. It did not break that, but it did not engineer any kind of rally from there. Whatever rally was there was sold into in last 10-20 minutes. So my sense is that this is a market which is going you classical signs of capitulation and might just go through the last phase of capitulation. And in last phase of capitulation, you normally see the outperformers fall. So today, perhaps IT stocks also start to unwind a bit, maybe Reliance, the kind of stocks which are holding up the market. So that could happen. Now, this is, not to say that, this is doomsday kind of scenario, but you have to be prepared for, what the data is telling you. Having said all of that, I think we are now reaching a stage where many stocks, especially in the Nifty Junior, that was a trade setup, of course. Many stocks in the Nifty Junior and B Group are now at multi-year lows and have reached levels where, you have valuation support. They're trading at below median valuation. And a lot of stocks which are falling on very low volumes because of buyer strike. And there's so many companies where results have been so good and still they have not reacted. There have been exceptions like Bata, but there have been so many companies where results are so good and still the market's not reacting because the market just doesn't want to buy right now. That perhaps will be the zone. Those mid-caps which have come out with good numbers but are still falling because of the market's mode, I think that would be the zone that you want to buy because when the rally happens, it will, right? These are phases. After a bull market, you have a bear market. After a bear market, you have a bull market. So when the rally happens, the same stocks will also rally on, again, low volumes. So that, I think, is just a point I thought I'll make. Having said that, just stick to low debt, healthy cash flow generating companies. I think that's rule number one. This particular cycle has been a lesson on not to touch companies with shady promoters
and leverage.
Because just look at what's happening. I mean, a blow up almost every week because of debt issues and promoters biting more than they can chew. I think that is something that should be this particular bear market phase. I think has been an interesting case study on what kind of stocks to avoid, regardless of what kind of market.
But when you say
yesterday when Uday Kotak was speaking about the fragility of the markets, this is something that I have been trying to put my finger on for the last 3 weeks. You spoke of the Friday accidents. The debt market has been giving us this. We over-concentrate on equity markets, obviously, because it's a retail market. But the wholesale market has been crying out that there is a problem of debt. There's a problem of trust. You can take, interest rates to 6 and 5.5%, but it's not going to make any difference to the cost of money for corporates. And that's because there is a lack of trust. People don't trust balance sheets. And that's why you're seeing these accidents. And the two are related. Anuj, you spoke about shady corporates and high debt. It is the high debt that has made even otherwise, corporates who run their companies well, go in for fancy structures, and therefore we are seeing a lot of pain. I mean, the 10,750 or 10,900 were held up by just 8-9 stocks. We have been noticing that for quite some time now, and now that veneer is coming off, it is quite clearly a debt problem.
But when, when you say stick to stocks that have low debt and healthy cash flow, what do you do about names like, say, an Ashok Leyland, stocks that have halved, reporting good numbers but not reacting to those numbers as well?
I think by sense Ashok Leyland, though it rallied yesterday, Sonia, I think, one swallow doesn't make a summer. That's my limited point. I think I would want to see, problem in Ashok Leyland has not been just numbers. It's the issue of management transition as well. Succession planning. And I think there's been an issue with both Ashok Leyland and IndusInd Bank, the two Hinduja Group companies. So let's see. Perhaps it sees some more short covering. But just based on one number, I don't think the stock will have a big. It may have put a bit of a near-term floor. I mean, if you want to put it like that, because the last month's sales numbers were also good. Just to add one last point to what Lata was saying, while I broadly agree with whatever you're saying, this is just one point that sometimes even good promoters do get swayed in
in good times.
Big bull market, and there are bull market mistakes which happen. While I agree that in 95% cases, high debt and shady corporate corporate governance will match, there will be 3 or 4% of instances where it would be a genuine case of a bull market mistake. Everybody makes mistakes, and
of course, Anuj, you can etch that in gold. What you said. What is the entire NBFC and debt mutual fund story? They're all sensible people, but they just got carried away in 2017 and 18 by the rush of liquidity, which they mistook for their investment genius and went on into building. I think the mutual fund story has not been narrated properly. It's going to create more accidents for the market. The kind of structures they have got into simply because there was too much money and not enough good paper.
Okay, by the way, as we speak, there are big accidents taking place in Asia. So the Hong Kong market is now down almost 400 points, and the Japanese market as well is down about 1.5%. You should get that up on your screen. So not looking like it's going to be a pretty picture this morning. Let's see which way things go. But let's kickstart Friday on that note and take a look at what our wise experts have to say as we head into trade this morning. Chris Wood of CLSA says many foreign investors will want to await the outcome of the pending elections due to be held in April-May. He believes that the issue here is not only whether the BJP loses, but if it is re-elected in a minority government which cramps Modi's style in terms of running the government in a concentrated manner around the Prime Minister's office. CLSA is confident that one outcome is clear. Whoever governs India for the next 5 years will enjoy the dividends from the significant structural reform implemented by Modi since 2014.
Yes, we are waiting for that. Money market views. Bhaskar Panda of HDFC Bank says the INR sharply rebounded from 70.50 in the last two trading sessions and was volatile. He expects that today may be another volatile day given all the global developments, and range for the day could be 71.05 to 71.40.
And on the bonds, Bhaskar Panda says yields have rallied after recent lows, mostly due to high oil prices and state-issued bonds hitting the market. For today, he says the old 10-year benchmark yield is likely to trade within 7.5 to 7.55%.
Okay, the global market's looking a bit iffy, but SGX Nifty is in the green, which is quite interesting. Here's Mangalam with a world view.
Absolutely. So the global markets were iffy. Yesterday we saw a decline in both Dow Jones as well as S&P 500. S&P 500 in fact snapped a 4-day rally, a winning streak. Now this is important because this decline wasn't on uncertainty with regards to trade tensions, wasn't on account of uncertainty with regard to global growth. This was backed by data, and that data was US retail sales for December down 1.2%, which has been the biggest fall that we've seen in more than a decade since 2009. So which is why we saw that fear percolate across the world as well. The US consumer or the US consumption forms a larger part of the US economy. And some consumer stocks, they took a beating as well. Coca-Cola reported an inline set of numbers, but the outlook for growth was weak, and which is why that stock was down by about 8.5% as well. One of the biggest falls that we've seen for that stock in over a decade, because Coca-Cola said they're being prudent in their outlook given the multiple reductions in global economic growth outlook for 2018 and our own experiences in some of the emerging and developing markets. Across the Atlantic, there was weakness too. Most of the European indices ended off the highs of the day, closing in towards the lower end of yesterday's trading range, and this on account of low US weekly retail, low US retail sales data. On Brexit, the UK lawmakers are now deciding the next course of action as to how to go about that. So that is a bit of uncertainty out there as well. Asian markets, all of them taking cues from the global weakness, all of them at the low point of the day. However, crude is higher, closer to the $65 per barrel mark. And in light of that, the SGX Nifty absolutely flat. So it will be very interesting to see how this goes from here.
Okay, thanks a lot for that. So let's see, SGX Nifty is flat, but it's not really showcasing the kind of pressure we're seeing across the other Asian markets. But the Brexit vote was the big focus, where Prime Minister Theresa May suffered another defeat after MPs voted down her approach to the Brexit talks. The MPs voted by 303 to 258, a majority of 45, against a motion endorsing the government's negotiating strategy. Opposition party leader Jeremy Corbyn said that this defeat will make it more challenging for Theresa May to convince the EU leaders that she has support back home for a revised agreement. Take a look.
Tonight's vote shows there is no majority for the Prime Minister's course of action in dealing with Brexit. Yet again, her government has been defeated. The government cannot keep on ignoring Parliament or ploughing on towards the 29th of March without a coherent plan. She cannot keep on just running down the clock and hoping that something will turn up that will save her day and save her face.
At the end, we will have a reasonable solution, what means something what is like the agreement which has been reached between British government and EU Commission, but because I don't see any real alternative for this, because everybody agrees a hard Brexit, a Brexit without any deal would be a disaster for UK and for Europe as well.
At the moment, the second referendum is a long way from being viable. There is no majority in Parliament for a second referendum. There isn't even consensus among the supporters of a second referendum, even what the question would be. So we've got a long way before we get to that stage. I think the line of least resistance, both for the UK and for the EU, will be to kick the can to extend. But I have to say that after today's events, which have demonstrated once again both Theresa May's complete incompetence in mishandling of these negotiations and the very dogmatic approach of some people on the of some Brexiteers in her party who would like us to crash out without a deal,